let's talk about something nobody enjoys, but everybody probably has to face at least once. We're going to talk about market volatility and the market dip. You may have heard before you retire, or if you're nearing retire, that if there's a dip, then you ride the dip, right? We buy more stocks, we ride the dip. But if you're living off the dip, that's a little bit different. And we want to discuss today, how do I keep my income flowing? How do I keep my stress down? And how do I maintain my retirement lifestyle without the fear of running out of money? If that is something that you'll be interested in, then today's video is for you. First and foremost, you don't want to panic. You want to have a plan. We want to plan our retirement with more wisdom and less worry, right? And so when you're talking about planning a retirement, ideally you already have built in a buffer. You already built in the fact that there is at least one recession every 10 years on average. And sometimes it can be two in 10 years. Sometimes you can feel like it didn't have any in 10 years, but on average, it's one every 10 years. We normally want to have an allocation for our investments that already takes into account a market drop. And I'll share with you a very simple portfolio, which is the permanent portfolio, where that portfolio was built with four assets that perform well in different markets. And the way that we normally think about it is, if the market is going really well, we're having a bunch of economic growth, where would be the best place to put my money? And you would say, yeah, probably in the stock market, because the stock market is going to go up. And I'll be like, yes, you're right. If the market is going poorly and we're in a recession, where might be a good place to have my money? And you would probably say, well, I think I want it on the sidelines in cash. They'd be like, well, yes, that would probably make sense. If we're dealing with times of high inflation, would you want your money in cash? You would say, well, no, would it be worth anything? So where would you put your money in times of high inflation? Normally, we would say maybe gold or even real estate. And then if we have the opposite, where it's times of deflation, then again, where would I probably want to put my money? And you would probably say, well, if my money is very valuable, that means I'm probably getting very nice interest rates on like money market accounts and things like that. So I would probably get long-term treasuries. I want to lock in these high rates because the value of the dollar is so high. And so you can see that depending on the economic climate, there is an asset that is going to perform very well. And so if I build my portfolio, keeping this in mind, then I'm going to be able to deal with the volatility better, because it's not that the entire world of assets is on a decline. It's particular assets are on a decline. That there's never a time where everything is losing money. It might feel that way, but there's always something that is performing well. So we need to lean back on our plan. What is my investment strategy? What am I supposed to do? How am I start already having cash reserves? Am I able to live off of some of these other assets while I'm dealing with this market volatility? How much of a buffer did I build into my plan, to where if the market loses 5% or 10%, maybe I've already baked that into my cake. So there's nothing to worry about. Just like if you were traveling and you said, hey, I gave myself an extra 30 minutes. You're stuck in traffic. Your GPS says it's an extra 15 minutes late. You're going to be like, well, that's fine. I gave myself 30 minutes. So I'm okay. 15 minutes is nothing. It's within the margin of error. And you want to have a retirement plan that's like that, where it's within the margin of error, so you can take a deep breath and be like, there's nothing to worry about. I have a plan built on wisdom that's already taken all of this into consideration. So I have less worry and more wisdom. The second thing that we'll normally look at is, what is my withdrawal strategy? We already talked about the idea that I have a plan, I have an asset allocation that makes sense. My money is already kind of diversified, but then I still have to withdraw the money. So how do I withdraw my money in a way that protects me when the market is not looking so great? And you guys have heard me talk, and I talk about it all the time because I do love it. And that is going to be the three bucket strategy. So I'm going to share this with you because it is one of my favorite withdrawal strategies. And hopefully it's one that makes sense for you. And if it doesn't, obviously don't use it. But I like the three bucket strategy because it gives me the ability to protect my assets even when the market is losing money. That my losses aren't losses until I sell. And so if the market is going down, no problem, because I did not lock in those losses yet. Have you seen it when you log into your 401k statement or something like that? You'll see that you have a higher balance, and then maybe tomorrow it's a lower balance, but you don't lock in the balance until you sell those assets. So normally that means we need to have a plan in place that protects me from having to deal with that. And so normally what we'll do is, you have three buckets, right? So I'm going to drum a bucket. So you have bucket number one. So put a one here. That's going to be my conservative bucket. And inside my conservative bucket is going to be in my cash bucket. So normally what this is 1 to 2 years of living expenses. And the reason we do that is if the market is volatile, if the market is losing money and I'm in retirement, I do not want to sell my assets at a loss because that decreases the chance of me making it through retirement with money still in my bank account. So if I had 2 years in cash or cash equivalent, so normally when we're talking about cash and cash equivalent, we're talking about our cash, it could be our money market account, or it could be like a CD. So we would consider these to be cash and cash equivalent. This bucket is probably not keeping up with inflation. And because it's not keeping up with inflation, we can't put all of our money here. But normally 1 to 2 years of living expenses works really well in this bucket. Then in our second bucket, this is going to be our moderate bucket. And this bucket is going to be focused on income. And because it's my moderate bucket, I know that the market is going to be a little more volatile than my cash bucket, but not so volatile that I need 5 to 10 years for it to recover. Then that's normally going to be when we're talking in the stock market. Normally, when we talk about the stock market, we're investing in assets that we're comfortable waiting 5 years. We're not day trading. We're not trying to figure it out in the next 5 months. We expect these to be good choices for 5 years. Does it mean that we will sell these assets if the market changes? Of course. If information changes, we can update our analysis. But when we chose the stock in the early going, we believed it was a good investment for the next 5 years. And so normally that means that we need to be somewhere around 3 to 8 years for this bucket. Because if there is ever a particular time that our income based assets don't perform well, they normally don't need that much time to recover. So, if of our most aggressive assets, we want at a minimum 5 years. This asset could be 2, 3, 4, it could be right around there, but we're going to be a little bit more conservative. And so, then the idea for this particular bucket is my income based asset. So, that's going to be bonds. And so normally we're talking about the bonds. These are probably going to be a little bit closer to the short-term bonds. So we're talking about normally under 8 years, right? So we're going to have bonds. This is debt. We can get treasury bonds from the government. We can get corporate bonds from a corporation. But the idea is that we're choosing very safe bonds. We're not going for penny stocks or aggressive ones, high yield bonds, which is what we renamed junk bonds, which is messed up. I know, but we're not going for high yield junk bonds. We're going for nice, successful companies with good credit, investment grade bonds. And then we're normally going to build this bucket with those. We would then be also considering things like a value fund. All we're saying when we talk about value funds is these companies already have the value. We're not investing in growth like, I don't know, I hope it works out. When you're investing in value, what we're saying is this company has already done it. It's a very successful company and we're getting it at an okay price. And so we get at an okay price. We're not going to get a great return on this, but the idea of this bucket is to keep up with inflation. If I can keep up with inflation, if I can get around a 3 to 5% return from this bucket, I normally feel pretty good. And because I'm just trying to match inflation, I'm able to maintain my lifestyle in many ways with just this bucket. Now, naturally, we are going to talk about bucket number three, which is the growth. But the idea of taking value versus growth is I hope this is a great choice. Value is they've already proven that they're a great choice. And so I'm going to get it at an okay price. I'm going to get a small return, but that's okay because that's what bucket number two is for. Better than cash, not quite as liquid as cash, but at least I'm able to keep up with inflation. Speaking of inflation, it is also common for someone to get treasury inflation protected securities. So those are called TIPS. And it's just as it sounds, I'm investing in bonds that are going to keep up with inflation. If inflation is 20%, then this bond should give me a 20% return. If inflation is 2%, then it probably will match and give me a 2% return. But at least I'm able to maintain whatever inflation ends up being. You could also look at some preferred stocks in this one. And so the idea of preferred stocks, if you were to look at a risk ladder, preferred is just as it sounds. It means that I have preferred position over a common stock, right? A common stock person, right? So a common stock person, if we were going to be paying out a dividend or something, the person who has preferred stocks gets the dividend first. And then the person who has a common stock, if there's a dividend left, they get it. So it just means that it's a little bit better than a common stock. And because it has a little bit less risk, then because I has a little bit less risk, we would consider them in the moderate income producing bucket as well. And then the last thing you'd probably consider in this bucket would be an annuity. Anyone that has an annuity, it would be considered a moderate investment. It's going to produce my income. It's probably keeping up with inflation. And then that's basically the way it matches out. Like that's all it's going to be able to do for me. The third one is then going to be my aggressive bucket. And because this is my aggressive bucket, I know that I'm going to need maybe 10 plus years because the market could be doing crazy things. And if we're dealing with market volatility, as we're talking about in this particular video, you can see that I already have two buckets that are going to be protecting me from market volatility. These two buckets should be performing okay, even in times of economic catastrophe. But this bucket is the one that's going to be hit by it. This is where we're going to be dealing with the damage. That is why I'm giving myself 10 years for this bucket to be able to recover because it's not a loss until I sell it. So as long as I don't sell it, it's not a loss. And so this would be everything from just your traditional stocks. It could be your personal business. It could be your real estate. Some people have commodities. Even if you were someone that had what are those like Bitcoins and stuff like that, that would all be in this bucket. That would be considered your aggressive bucket. And the reason we put 10 years on the aggressive bucket is because I know that real estate values could go down. But if I have 5+ years to wait for it to recover, do I think real estate values would recover in 5 years? I think we would say yes. There could be a recession in the stock market. It could lose 60% of its value, like it did in the Great Recession of 2009. But by 2015, where were we? We're in the middle of one of the best bull runs that we've had in like the past 100 years, right? Like it was a really good economic climate. Interest rates were low, the Fed was printing money, completely different environment. It was very easy to invest. I'm saying that if you look at the recessions, even if you go back to the 9/11 recession, if you go back to the Y2K recession, in 5 years from there, were we still in a recession? You would say, no, we were in some of the best economic growth environments. So the idea is if I give myself 5 years and I am able to live off of these assets, I should be able to wait for the market to recover and then I can replenish the bucket. So the way it would normally work is you have 2 years of living expenses. Maybe you've spent half of this, so you have like 1 year left. I'm going to take some of my moderate bucket and I'm going to sell it and purchase cash. So my annuity, I'm going to take some of that and it'll just go into cash, which obviously makes sense. I'm going to sell some of my preferred stock and I'm going to buy money market accounts. I'm going to sell some of my bonds and buy CDs. I'm going to sell my moderate to replenish my cash bucket. That thing is an ability to survive regardless of what the economic climate is. Well, at some point, I'm going to have to refill my moderate bucket. You're right. So the idea is if I have 2 years on this one, and then when there's a good time, I'm going to sell and get another 2 years on this one. At some point over that, I should be able to start selling my aggressive bucket, that the recession should have recovered and we should be in a good spot. So if I'm able to sell my aggressive bucket now, so the stock market has recovered, it's been 3 years, it's been 5 years, however long it's been, I'm now able to start seeing some of my returns returning back to the way they were. And when that happens, I'm able to start selling this. So I start selling my stocks and buying preferred stocks. I start taking profits from my business and I start buying value funds. I take some of the rental income from my real estate and I start buying some of those investment grade bonds. As I do that, I'm then replenishing this bucket. And if you use a three bucket strategy, it should put you in a position to be able to ride the market volatility without you actually running out of money or risking your overall retirement lifestyle. Now, the where it differs for each of us is based on our risk and how close we are to retirement. It's not impossible for someone to have 30% of their investments in cash, and they could have 40% of their investments in the moderate bucket, and then they would have another 30% of their investments in aggressive. That's not impossible for someone. It's equally optional for someone to say, you know what, I have maybe 10 years of retirement, and so I only want 20% of my investments or 10% of my investments in cash. And then I will have 40% of my investments still, and then I'll have 50% of my investments aggressive. You could. And so you're able to take your risk tolerance and how soon you need the money for retirement to then decide how much risk you need. And it's not impossible. And I've seen some people where they'll have 50% of their investments in cash And they might have 30% of their investments in the moderate bucket, and they only have 20% of their investments in aggressive. And that works for them as well. There are lots of ways that you can allocate this, but the way the three bucket strategy works is it gives me the ability to not have to lock in these losses, or I'm able to maintain my lifestyle and protect myself and still be in a position to where I'm able to take advantage of the market, where I don't have to take all the money out of the market because I don't want to have to worry about the market losing money and I'm having to sell my assets. I'm able to maintain something where I'm able to ride that wave and I can take advantage of the greatest bull run ever that we had in 2011 and 2019. And I'm able to take advantage of the runs that we're on now because I have the other portion of my assets already set aside to live off of while wait for any market recoveries to happen. The third thing to consider when dealing with a market downturn during retirement is we might want to cut back. And we don't have to cut it off completely, but maybe we take trips a little bit more local. Maybe we take trips that are regional, but maybe we don't travel to Europe when the market is down, or we lower some of our lifestyle expenses. Because you guys hear me say it all the time, you normally have three choices when it comes to dealing with retirement. We normally can increase how much we put in, we can decrease our lifestyle, or we can retire a little bit later. And because you guys are already retired, we don't normally get to use the first two levers. We don't get to increase our contributions and we don't get to retire later. So that means we would then focus on bucket number three, which is decreasing our lifestyle. And there are so many creative ways that we can do that. I remember when I was first starting the company and I didn't have any money. Well, we would have Christmas and my mom would help us to be able to just get presents for the girls. And we would have to get creative. And so we would find different events that were put on inside the community. And some of them were great, where it was almost like a mini fair. And we went to these events and they were free because the vendors wanted the traffic and they wanted to be able to advertise to families. And so we would go to these events where there would be like 20, 30, 50 vendors set up. And then they get to give you their spiel. Almost like if you think of it when those people with those timeshares where they're like, hey, we'll pay for 3 days, 4 nights. All you have to do is listen to a 3 hour presentation, right? Stuff like that. It's basically like that, except there's lots of opportunities like that where people just want to be able to get to know you, to present you with some options. And so we would go to those. And the kids would get candy and they would play the games and we would do all sorts of amazing things for free. And so all I'm saying is when it comes to decreasing my lifestyle, it doesn't mean I have to decrease the actual enjoyment of my retirement. It just means I decrease what I do to fulfill that joy. So I could be someone that will go to the beach more often because my kids love the beach and it's relatively free. I might decide to get a new video game for our Switch. And then as a family, we all sit and play the game together. And that was maybe $80. So we could all sit aside and do that, where we all order pizzas because pizzas are a little bit cheaper than it would be for us to go sit in a restaurant. All we're saying is that we're going to get more creative on the lifestyle choices where we're still enjoying ourselves. We're still having a great time, but we're not going to be doing the most expensive things while we're waiting for the market to recover. The fourth thing to think about when dealing with a market downturn or retirement is we got to turn the TV off. The news can scare the mess out of you. I know I stopped watching local news probably at least a decade ago. And it was because they would just tell me all the worst things that were happening to get me to watch more of it. And if you've ever watched a sporting event and then the news kind of pops on, the first 10 seconds of the news are going to talk about a robbery, a burglary, a murder, a car accident. Something is going to be talked about because inside of our mind, we're thinking, oh, am I in danger? And your mind's like, we need to know more. I want to protect you from the danger, which is fine. Your mind obviously wants to protect you. But it does mean that we have to sometimes limit how much of that we take in. And so if you're going to be watching the news about the stock market while your investments are in the market, you would see people that will tell you, oh, this, you have to sell it, you have to sell it. And then literally a few minutes later, someone else will come on and be like, you have to buy it, you have to buy it. And now they put panels together where it's a whole table. There's like 6 people at a table, and half the people are telling you that the market is going to cave in, and half the people telling you is the best time to buy in your life. So what are we going to do? I would say we're going to turn the TV off, turn to a different channel, go enjoy retirement life. Market downturns are very normal. Do not get caught up in any of those market downturns. That's why it's so important to have an asset allocation that already predicts that we're going to be dealing with that. That's why it's so important to have a retirement plan that already takes into consideration that we're going to possibly lose money, where we have these buffers built in. Because then when the news and everybody's freaking out, you don't get caught by that. You don't allow the tail to wag the dog. You're not selling your assets because, as you would imagine, If you sell in the worst time, then you are selling at the lowest possible value. And unless you have a genuine reason to sell it, that is not going to be a long term option. And so when people ask me, Dre, when should I sell my assets? I normally tell people, you sell when you have a better place to put your money. I forget where I read that, but it's such a simple, but yet a true statement. If you have a better place to put your money, then put your money there. And then the question becomes, how did you choose that was a better place? Did you read the financials? Did you see something in the industry? Do you know something about the CEO? Like, how did you make that decision? Because if we're just making the decision because we saw something in the news, that's not going to probably be a good decision. If we just made the decision because it seems like everything is losing and I want to sell so that I can sleep at night, I can appreciate wanting to sleep at night. But it may have been better for us to not even be invested in those assets because that is still not a winning strategy. Us selling so that we can sleep at night in a market downturn still locks in losses that we don't want to have. Ideally, we have an investment allocation that already takes our risk tolerance into consideration, already takes our risk threshold into consideration. And so that way, when the market does happen, we've already built a plan and an allocation that is good enough for you to be able to say, I can still sleep at night. So I'm okay, Trey. Because the reality is, if we're buying high and selling low, that like we're going to go broke. That if we're going to buy low and sell high, which is what everybody says, that requires us to make some purchases in the down times of the economy. Right. And I know it can feel like very nerve wracking, but that's all rebalancing really is. That's why we rebalance. It removes the emotion from investing. If my allocation is supposed to be, and I'll show it to you all real quick, where I have the permanent portfolio. So I have 25% in the stock market, 25% in bonds, 25% in bills, 25% in gold. Well, we already mentioned that I know my stocks are going to do well in times of prosperity, my cash during a recession, gold during inflation, long term treasuries during deflation. Well, I'm already allocated that way. Well, I have to maintain that allocation. For example, if the market was doing well and I saw that my stocks were now 30% of my portfolio, I saw that my stocks were now 50% of my portfolio. Well, that probably means that your cash is doing poorly. And so now means that cash is less than 25% of your portfolio. So if I'm just going to do a rebalance, removing the emotion, I know that that means that I'm going to sell my stocks and buy cash when I know that cash is underperforming. But that is how you buy low. If you only buy stocks when they're performing well and you only buy cash when cash is performing well, then you're only buying high. And that's why we normally will build an asset allocation, a model portfolio. So that way we can remove our emotions and we just stick to the plan. And so you're going to want to be able to do that for yourself as well. And the fifth thing that we want to look at when we're dealing with a market downturn in retirement is whether we can take advantage of it. So we normally want to look at our tax strategy. So I'm going to go back to my whiteboard so that I can share with you a few things that I normally look at when I'm dealing with this, because we know that we're going to lose some money at some point because that was how we built the portfolio. So then the question ultimately becomes, what do I do when I start losing the money? And that is where we talk about the idea of tax loss harvesting. Now, I don't want to go into too much detail because I don't want to overwhelm you, but the idea of tax loss harvesting, I'm going to take, let's say we have investment number one, and we have investment number two. So let's say in investment number one, we had a 25K gain. And let's say in investment number two, we had a 30K loss. So we're sitting here with $30,000 in losses. What can we do that would be beneficial to deal with this loss? How do we turn lemons into lemonade? Because we've already have an asset allocation that we already recognize we're going to lose in a portion of our allocation. So what can I do? Well, I can go ahead and I can take 25K of the losses and I can use that to offset the gain, right? So we'll say they offset each other. So that means I need to pay $0 in capital gains. Look at that. So I made money over here, but I don't have to pay any taxes on it. So that's pretty nice. And if you're wondering, let's say that your capital gains would have been, I don't know, let's say it would have been like 15%. Let's say it would have been kind of the normal 15%. So that means you would have had $3,750. And capital gains would have been 25K times 15%. So that is how much you save by offsetting the losses, right? So this is already our first savings. But over here, we only use $25,000. So that means we still have a 5K loss that we have to deal with, that we have something we can do with this. Well, once you offset all of your capital gains, you are allowed currently to use 3K of the losses as ordinary income. So you're going to offset another 3K in ordinary income. So if you had something from your 401k or like an annuity or something that would be taxed as ordinary income, you now can take off 3 more thousand of that. And so then we'll say if you're already, crushing it, living your best life. So what we'll do is we will take that $3,000 and we would times that by whatever your tax rate is. So let's say your tax rate would have been like 35%, saying you're crushing it to make math easy for me. And that would be $1,050. So that's another $1,050 that you saved. So I saved again. I know. So you say that ordinary income because I was able to take 3K off ordinary income, 35%, whatever your tax rate would have been. So I saved another $1,050. We're not done yet because I technically still have another 2K in losses left over, but you can't offset anything else in the current year. So you get to carry this forward, which means that if next year I have no losses and only gains, I still have $2,000 in losses that I can offset some of my gains next year. I get to carry it forward. And so that's the way the current tax system is. Obviously, they talk about changing it every single year, and we have to actually look at it literally at the beginning of every single year because they do make changes to it so often. But what you can see here in this particular situation, I was able to save $4,800 total. That you could have had a tax bill for $5,000, and now you don't have a tax bill at all. I know that feels good for me when you're going through the little programs and you see the number clicking and you're like, oh, am I going to pay taxes this year? And then the number kind of flips over and you're like, yes, no taxes this year. So for some of you, that might be the difference between you paying taxes and not paying taxes. For others of you, that's just $5,000 you get to keep in your pocket. And that could be the cost of a trip. Where now you're talking about market volatility, where we're going to have the money, where now you're like, oh, bam, I done created $5,000 that I now can spend on my retirement lifestyle. And if that were not enough, you also could have lower income that could reduce your IRMA, where you're not paying those higher premiums when you enroll in Medicare. You could also find where you deal with market downturns. Those are great times to be able to do Roth conversions. Because if my portfolio is decreasing in value and I believe that it is going to recover in the future, I have a moment in time where I can sell some of these assets for my 401k and my other pre-tax accounts, pay less in taxes because the amount is lower, roll it into a Roth account, it then recovers, and I have all this tax-free growth. There are so many ways that we can structure as far as the tax benefit to where you don't have to be like, oh, I lost money and I'm just taking the L. Where we can be very proactive, working about, oh, this is a great opportunity. Because the reality is that in economics, in most situations, I'm someone who doesn't think the circumstances define us as much as what we do in those circumstances that define us. And that is why in times of economic growth, sure, there's going to be tons of companies that have phenomenal growth. But it's equally true that there's going to be companies that file for bankruptcy in the best economic climate. And I think we would all agree, of course, there's a company that files for bankruptcy every year. That also is true that there's going to be a company that had their literal best year ever in a recession. And again, we would say, of course, that's true. Which ultimately means it's not as much as the economic environment and the circumstances, it's more, do we know what to do in that environment and those circumstances so that we're able to take advantage of the opportunity and ensure that we're able to set ourselves up for great retirement success into the future. If this is something that's got your wheels turning, you're like, ooh, I think I would like to learn more about that. You have two things you can do. Number one is you can go to sittingwisdom.com and I'll put a link in the show notes. You can click on I want a worry-free retirement and just come. We do a live every single Wednesday, the 5 hidden dangers to a wealthy retirement. and 3 frameworks that I use with my clients to make sure you don't have to worry about them. The second thing that you could do is you might be someone that's like, Dre, I'm just ready to get started. And if you're someone that's ready to get started, you can definitely schedule some time on my calendar and we can get together and we can see whether it makes sense for us to work together. And I'll give you as much information as I can on all the topics that are the most value to you. And if that is something that sounds like a good idea to you, I look forward to having that conversation with you. As always, I'm thankful for the time that we have together. Until next time, stay safe and enjoy life.